What's up, everyone? I got the Canadian note guy with me, Nathan Turner, and he reached out because he's done some unconventional things in the mortgage space. So pumped to have Nathan on and hear about how he got into this. Was after the financial crisis that people who have bought real estate over the last 10 years seem to have forgotten about, and everyone that I talk to that's buy a house is like, "Oh, why would you never buy real estate? It only goes up."
If only that were true.
So, yeah, I mean, 2008, well, in the investment world, once you get past 10 years, financial companies don't have to disclose that on their returns.
Yeah.
So people don't even see that anymore. What were you doing after that? What did George Bush say? Meltdown. What were you
I
doing that discovered these mortgage notes?
there's two things actually. So one, I was trying to sell my gym franchise. I had two gyms. It was called Curves. It was a popular gym for women back in the early 2000s. I had two of those, and those were actively for sale. And as time marched on and as everything got worse and worse, the price that I was asking went down and down and down. So it was not great in that case. At the same time, I had started doing some real estate fix and flip, and as the market turned, there was one property that I got stuck with. So I ended up renting it out, and I was a landlord from across the country. I was in Canada, so I was living in Montreal, just above Vermont, and the house was in Saskatoon, which is just above Wyoming. So way over on the other side of the country, and doing everything from a distance. Figured out pretty quick I didn't really like being a landlord. That was not as glamorous as it was made out to be. But that was kind of right at that moment. That's where I was, just trying to figure out, okay, and what's next?
Are curves even still around?
That's a good question. I'll have to do a Google search.
I know like Orange Theory and like F45 had become very popular, but Curves was like a this might be I never went to a Curves, but it was geared for
Yeah,
women and only for
yeah,
women, so that way
yeah.
like working out wasn't as scary.
Yeah, not as scary. It was actually a really great system. They use hydraulic machines. So somebody who's super fit can push machines harder and get resistance for them, or somebody who's, 85-year-old grandma, she can go in there and push as hard as she can, and it still gives her the same kind of workout as the young 20-year-old. So it was a great concept. It worked really well. We saw tremendous results from it. But as the economy gets bad, what's one of the first things people cut from their budget? Gym membership,
Yeah, especially a boutique gym membership.
right?
Were were you able to get enough out of the business where you were able to come out unscathed, or did you end up having to take a loss that most entrepreneurs have a few on their belt?
Yeah, no, not even close. We had two clubs. We listed them both in 2007 for $200,000 each. By the time we made the sale in 2009, just right after, in between and everything was going all kinds of crazy, we had combined the two clubs to one. So we
Mhm.
consolidated them down to one, and we sold that one for $20,000. So we were nowhere close to being in the black on that one. It took a big loss, but honestly and truly, my wife and I have talked about this, where as difficult as that was, I don't think I would trade it. I don't think I would do anything different, because we did the best we could with the knowledge and experience we had at the time, and the lessons we learned from that, and just the way that we've been able to progress from that, it's totally priceless. So difficult as it was, no, it was a great learning experience.
What was going through your mind through that experience as it was unraveling and your asking price went from 200 to 180 all the way down to 20,000, which I guess that's better than zero. At least you
Better
got
than
something
zero.
for it, but obviously that's what like more than an 80% discount.
Yeah, we were supposed to we had two separate clubs and then it went down to one and then it was only 20. So it was actually, we were hoping to get 400,000 out of it and we ended up getting 20. Going through my mind, it was interesting, kind of like the sort of the stages of grief. Um, but I do remember at one point where everything was just bonkers and sleepless nights and all the rest. And I remember having the distinct thought, no, I'm in charge. This is my business. I run the business. The business does not run me. And that was a total turning point where I was like, no, 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 I'm in charge here, and was able to kind of really, things obviously didn't turn around where we made any money off of it or anything like that. But in my mind, that was a major turning point. Was I'm in charge. I run the business. The business doesn't run me, and that was a huge shift in mindset.
Did you come up with that on your own? Did you get that from like a book? Where
That was on,
it just
that one
came?
was on my
It
own.
just came from somewhere within.
Yeah, that one was on my own, but boy, oh boy, that was good. That's what I needed at the time. That's what I think really helped us kind of get out of it with our, not with our pocketbooks intact, but with our mind right, where we understood that, what, some things were out of our control, some things we made mistakes on, but in the end, you just got to roll with the punches, and whatever comes next comes next.
And then shortly after that, you discovered these mortgage notes. What was this something you just stumbled upon?
Sort of. There was a group of California investors that I had kind of networked into where, again, it all related to the same crisis that we all went through. They had bought a portfolio of about 60 properties in April of 2007. So, like, right at the very top of the market, the most they could have spent on it, that's what they spent. And at the time, the idea was they were just going to take this portfolio and sell it off to another organization. Um, Things went sideways. They weren't able to make the deal. So by the time I came on the scene in fall of 2008, when everything was going all kinds of crazy, uh, the charge that I was given was make lemonade out of these lemons. Like, we know we're way underwater on these, but what can you do? So it was my old partner and I, we kind of thought we'd invented seller financing, where we started selling these properties on terms and creating notes. We didn't even know they were called that. We were calling them contracts. Like, we had no idea what we were doing, but it was a good idea. And then as I kind of did more research into it, and the idea was, okay, there's got to be a way to sell these things. Like, there's got to be a way to get out of them. And that's when I was kind of fell into this note world. I went and took a class down in Dallas from a guy. He said, hey, you should come to this conference coming up in a couple of months. So I did that, and just it blew my mind. I walked in this room and all these people that were there talking about what I had just discovered on my own, and they'd been doing it for 20 years. And I'm like, this is a thing. People do this. And like, that was really the introduction. And I thought, man, this is cool. This is what I want to do. And then just made all kinds of mistakes in the beginning and learn as you go. But it's been really good.
So how would you describe these notes to someone who doesn't know what they are? I believe what you're referring to is like I remember in the movie The Big Short, they were like
Yeah.
packaging these
Yeah.
deals, and then one bank was selling it to the other bank, and then eventually someone got left with holding a bag of crap at the
Yeah.
end of it.
Yeah. And the Big Short is a great introduction into the business because that's exactly what it is. They were trading around these mortgages, passing them off as if they were, A1 paper, where it was clean, everybody's making payments, everything's fine. It wasn't. And eventually, at the end of it, somebody got stuck with it, and it was, loans where nobody was making any payments. House values were far less than what was owed, and it was a mess. So the way to think of it is it's the mortgage attached to the property. So I'm not buying houses. I'm buying the mortgage with the property as the collateral. So I'm acting as kind of like a private bank. So especially back in the day, banks were stuck with all these loans that weren't doing anything. And that created all kinds of problems. They've got negative negative numbers on their books. Like it's not a good situation. So, and then they got this insurance bailout from government, so it allowed them to sell off these non-performing loans to whoever. So back, oh, it was insane. They would sell them off probably 15, 20 cents on the dollar. Like if somebody owed 100,000, you could buy that loan for 10, $15,000. Like it was nuts. House value may have gone from 100 down to 80 or 50 or whatever it was, but still there was some value there. So that's kind of how that got started. Banks would sell to these large hedge funds for, hundreds of millions, and then the hedge fund would look at it and say, okay, we want whatever their box was, these states, or we want balances over this amount, or we want, whatever balances where last payment was made in the last year or something like that. They'd come up with whatever criteria. Anything that fell outside of that criteria, they would sell off to guys like me. And they'd sell off even one at a time where I could go in and look at a spreadsheet with like 300 loans available for purchase, and I could say I want that one, and I would buy that one. And I paid probably more like 25 or 30 cents on the dollar, but still it was a ridiculously good deal, and it allowed me to make all kinds of mistakes and still be okay.
I believe this m may happen to folks when like all of a sudden it's like, oh, you have a new mortgage company
Right.
and you get no notice. You're just like basically like, here's your new person. This is who you need to pay. Like they just
Yeah.
basically are, kicking the can down the street, as someone might
Yeah.
say. I mean, it happens a lot more than people realize. But people just be like, oh, I got a new mortgage company, whatever. They don't even think
Yeah.
twice about it, but they don't understand how much of this note, this mortgage is moving and what sort of
Yeah.
effect it has on the global economy.
Definitely. And especially back then, they were getting traded like crazy. So I would, by the time it got to me, I would buy the note, and then I would would do like a title search and see every time that this loan was bought and sold, there's a record of that. So we'd go back and there'd be like 7 transactions in the last year where it had switched hands from this bank to that bank to this bank to that bank, and then eventually down to this hedge fund and then over to me. And so it was not uncommon, especially back in those days, where I would get in touch with the borrower and say, okay, so now I'm the one that owns the loan. So let's figure something out. And they said, really? Like I've had all this money saved up. I don't know who to pay. It's changed hands so many times. I don't know where it's going. Great. That's where I'm that's where I'm coming in. Yes, you can pay me. I'm happy to take your payment. And we'd have all the documentation and all that to prove that yes, we really are the right ones to pay. But that was not uncommon. It had traded hands so many times.
And you're still doing this today, correct?
I am. We've changed our strategy a little bit where now I'm buying performing loans. The non-performers where people were not making payments. Luckily, there's not as many of those available today. The economy's in a much better place. Everything's going much, much smoother. Um, and that's a big part of it. So availability and pricing, the prices of these non-performers just went up and up and up. And so it didn't make sense anymore as far as, dollars and cents. So now we're buying performing loans where people are making regular payments. And that is actually really rewarding as well, where we can help people if they do run into some kind of an issue. I'm not a bank, so let's figure it out and I can help them get back on track, however.
This is interesting because I was having a discussion with a friend, and he is been doing real estate professionally for call it 15 years.
Mhm.
And I made a video talking about how I don't know what I said, but I believe it had to do with a primary residence is not a good investment. And he said he was like kind of offended because I was like explaining to him, I was like, you are like a professional. You know exactly what's a good deal, what's not a good deal, versus, family of four. They're
Yeah,
relocating across the country. They're like, we got to buy a house. We need a place to live. We don't want to rent.
right.
They are buying purely on emotion versus what you're doing is you are looking strategically from a quantitative point of view.
No, you're not wrong. I think that's right. It's not a great investment it's not a great investment that's going to pay you anything. It actually, Robert Kiyosaki talks about this in his Rich Dad Poor Dad book. Your primary residence is really your biggest liability. We like to think of it as a great asset, but it's really your greatest liability. You owe more money on your property than you owe on anything else, and it's not making you any money. However, if you can pick up a property and then rent it out, or just get the note on it or something like that, that's a totally different story. That is income producing.
Yeah, because I believe it's important that people know the difference. Like, obviously, buying a home, having a stable place to live, you're like, hey, this is where we're going to be for the next 20 years. It
Yeah,
makes sense to have a stable household. Like, totally, like, if that's the case, buy a house. However, if you're more career driven or you want to make sure that you can get up and go and you don't have to second guess, like, hey, I got a promotion at work. They want me to move from Texas to Florida. You don't
mhm.
have to think about like, oh, I gotta sell the house, I gotta pack it up, I gotta find a new house.
Right.
So what I attempt to do is like educate people on like, hey, like a house could be great for some people, but it's not the end all be all investment that social media tells people it is when it comes to house flipping or multifamily or
Sure.
doing all this, Airbnb arbitrage was like a thing.
Yeah, yeah.
Uh, those are all it seems like what you stumbled upon was like an arbitrage opportunity because of what was going on in the economy. However, now you have to be skilled and know what to look for in order to make it work because I'm sure you're looking at a lot of more things than you're buying.
Oh, definitely. Yeah, yeah. And you're right. It is, and especially with notes, it's a cash business. So meaning I can't go to the bank to get a loan to buy notes. So I'm working with investors. I just put together a fund. We're raising capital for that so that we have cash to go out and buy more of these loans that we can collect on. And for me as an operator in that way, if I'm using my own cash, great, then that's an excellent investment. If I'm having to borrow cash, I have to buy it at a good enough price so that I can pay the investors and still make money on it. And then scale that to a point where, if I make a little bit of money on each loan, if I've got 100 loans, then it makes sense. But if I've got, two loans that I'm trying to pay investors and survive on, that's not going to work.
So it sounds like when you're bringing investors in, the deals have to be much larger, similar to like a Walmart model. Like they have low margins, a lot of volume, versus
Mhm.
more of a Louis Vuitton. They're selling luxury, so they're not
Right.
selling as much, but they're making a lot more per unit. So it sounds like with individual money, you can make a higher return with less because there's greater margins, but with more money, there's less margin. That's what it sounds like to me.
Yeah, no, I think you're right. And it's interesting because while we're running the fund, for me and my wife and I, our whole purpose in doing that, the income is great, and I'm very grateful for that. But the purpose of that income, besides paying for my life, is to build up my own portfolio of notes so that I can eventually actually close down the fund, say thank you very much to the investors. And now I'm just self-funded and my returns don't have to be as high. I can buy loans at, less of a margin because now I don't have somebody else that I need to pay.
You have less costs.
Right.
You know, these companies that you're able to get things for very affordable, they have mastered the manufacturing process versus if you have an idea, it's kind of like plasma TVs used to be like what, like 10 grand.
Yeah.
Now you can go get a TV, like really nice TV for like $100.
Yeah. A couple $100 maybe. Yeah.
So it now like you stumbled across these notes.
Yeah.
I mean, it doesn't sound like you had like a passion for it. You're just like, I see an opportunity. This is like a once in a lifetime opportunity with what's going on. I got to jump on it. So how do you make it fun? Because it sounds like your job, if you were to explain it to someone, they'd be like, that doesn't sound fun at all.
Yippee. Yeah.
Yippee, woo.
It actually, I think it went from an opportunistic thing into it actually is a passion. I really enjoy it. I like buying the notes, and then one of the things that I actually enjoy is when people are in trouble because I'm not a bank, and then we can go back and say, okay, let's figure it out. Let's say, they've gone through, there's a couple of different things. So there's loss of job, divorce, um, relocation, things like that. Some kind of life event, something that's come up where they're not able to make payments. Something, got in the way. Um, so we can go in and say, okay, so what's the story? What happened? What do you think is going to happen? Like, are you lost your job? So do you have another one lined up, or is the job market for your skill set there, or what is it? How are you going to get back on your feet? And then once they have landed that new job, is say, okay, so given your new income, does that $800 a month payment still make sense? If it does, great. Let's get you back on track. With your arrears, we'll figure something out. We'll tack it back on the end of the loan. Well, if they have it saved up and they can pay the arrears, great. Whatever the case might be, we've got lots of options. If they can't make that $800 a month payment and say, okay, what does make sense? Could you do seven? Could you do six? And figure out, again, massage those numbers and figure out how we can make it work for them. And for me, that's really fun. It's really rewarding. It's solving the problem. It's solving, coming up with an issue and then coming up with a solution. So I enjoy that a lot.
It's like tapping into your creativity.
Right. Yeah. I don't paint. My dad's a great painter, all these different things. That didn't get passed on genetically somehow. So this is the way I do that.
And that's what typically a bank would do is be like, all right, like we'll stop payments, but there's gonna be a balloon in like 6 months, and you're gonna owe us a ton of money. Take it or
Yeah.
leave it. So you're able to structure it in a more flexible way. What's like the most common way that you're able to adjust these notes so that if someone goes through a bad time, they're able to get back on their feet? You said, I know you mentioned like arrears, put it towards the end of the loan. Like,
Mhm.
I think it'd be fun to like walk through a scenario, like your thought process on like how you do that.
Oh man, there's so many different things we can do, and that's what makes it so fun.
So let's say I lost my job. I've
Yeah.
missed three payments. I'm starting a new job next month, same income.
Yeah.
Um, but I had to like deplete my savings during that
Yeah.
time. And oh, and also you probably heard this one, like, oh, I started a new job, but I missed the first pay period, so I have to wait 3 weeks instead of like 2 weeks or something
Yeah.
like that.
Yeah. So first things first, I would get a proof of the job. So, you know,
Verify.
yeah, verified, trust but verify. But I appreciate people are just trying to get by. But yeah, we're gonna trust and verify at the same time and just look and make sure that they really actually do have this job and it is the pay that they say it is. So there's that element there. Um, so now they've got some arrears. They've got 3, maybe 4 months of missed payments. Typically in that situation, they've used up savings. We'll probably add it back onto the end of the loan. So let's say the loan balance is $100,000 and the arrears now it totals up to call it $3,000.
Mhm.
So now that the balance of the loan instead of being 100,000, now it's 103. And it may adjust with that much of a difference. It'll adjust their monthly payment maybe by a couple of dollars. Like it won't be hardly anything as far as their cash flow is concerned. But then that makes it right in the end with them being able to, you know, pay everything off without just not being able to pay those arrears. Um, we've got to be fair to everybody involved. So yeah, that would be pretty typical. Let's say let's take it a step further. Let's say that they say, you know what, my pay is a little bit less than it was before. So we'll say, okay, so there's a few things we can do. So your original term was 30 years, and you're 5 years into that term. So we can go back and look at maybe stretching that back out to 27, 28, 29, 30 years, whatever the case might be. And that'll actually lower their monthly payment because now it's over a longer time. So it's that same balance, but now stretched out, 3 or 4 or 5 years longer, and it lowers their monthly payment. We've done all kinds of things. We've raised their interest rate, we've lowered their interest rate, again, just to get that monthly payment and to a point where it makes sense for them and makes sense for us at the same time. So there's tons of options. It's really fun. It's interesting, going back when I first started, when I buy one of these loans, I get the whole loan docket. So I got like the file folder with all of the information in there. So it's fascinating to me when we first started. I'd get these loan packages and started leafing through all the information in there, and included in there is bank offers. Like, so again, let's say it was $100,000 balance. You owe all this money on here. We'll make it a one time. If you can pay $25,000, we'll call it even and we'll make the rest of the mortgage go away. And in my mind, I'm like, that sounds like a good offer, but if they couldn't make $500 a month, what makes you think they've got $25,000 that they can just magically come up with and make this mortgage right? So I think there was a lot of that going on. And I think going back in time, more banks were in a huge pressure to do something. And so these letters that they were sending out, well, yeah, we're doing something. We're making offers to people to be able to get back on track or to pay off their mortgages, but it wasn't realistic. Whatever their offer was, it wasn't a realistic offer. It wasn't anything that anybody was going to be able to do. So in the face of, public pressure, they could put on this front and say, yeah, we're offering people these deals, but they were totally unrealistic deals. There were nothing that people could do. So it's fun to kind of look at that and say, I can do so much better. We can make this work way better than the banks could.
So essentially, you're like delaying your company's profits, pushing it back to help someone out. And then in return, you help them out. And then in the end, you probably end up making more. But also, I mean, you gave up something in the beginning to get more in the end.
Yeah. Yeah,
So
and it's worth it. And the further I've gone along, I started with fix and flip. The further I've gone along, I don't actually want to own the property. So I'm actually really motivated to help that person get back on track because I don't want the house. That's a liability now where now I have to pay taxes. Now I have to fix anything that's broken. I don't want it. So I would way rather get the person back on track, have them paying the taxes, have them fixing whatever needs fixing. That's a much more interesting position for me.
you sound like me. Like, I don't want to fix anything. I don't want to pay the taxes or the
Yeah.
insurance. I'm working with someone right now who they bought a house and then someone along the line didn't compute their escrow payment enough, so they had a underpayment, so they have to pay an extra 800 and something dollars a month to get their escrow back where it needs to
Oof,
be.
ouch.
And then they're asking me like, when is this escrow going to be repaid? And then I have to like go in and calculate it and figure it out. And then I'm also explaining, I was like, listen, your insurance and your taxes most likely are going to go up incrementally every year,
Yeah. Yeah.
unless there's some sort of pullback. But it seems like they put a lot of barriers in place to prevent that from happening, which is good. Not just real estate markets, but also like stock market, things like that. They put in a lot of
Yeah.
rules and stoplights to prevent things from completely evaporating.
Yeah. I hope so. I hope so. We don't really want to see 2008 again. That was hard.
Yeah, but you said earlier what you're seeing things seem like they're going well in the mortgage space and what you're seeing in your world.
Mostly. There are some cracks in the armor. We're starting to see like specifically short-term loans where people are loaning out for people to do like a fix and flip or something.
Hard money.
Yeah, hard money. Those ones, there's been an uptick in defaults on those for sure. Um, Regular residential, there's been a slight uptick. I don't know if it's significant yet. We'll kind of have to wait for some more data to come out on that. But in those short-term loans, definitely there's been an uptick in defaults. And so that's kind of the canary in the coal mine. We'll see how that goes.
Yeah, I mean, hard money. I would get people would call me sometimes like, "Do you do hard money?" I'm like, "No." Like, is there a lot of money to be made in hard money, or is it just like or is it just people who like think they're making money? Like, do you have any
Yeah,
insights on
actually,
that?
I've been looking more and more at those. There is money to be made, and because of high interest rates. So when you're doing a hard money loan, I mean, 12 to 15% is pretty standard plus points. So you're saying like, I will give you money, $100,000 at 12% plus 2 points of origination fee right up front.
So two
So
grand.
yeah. So that's not bad. Over the course of the year, then if everything goes right, you get paid back after 12 months. That's a pretty good return in 12 months time. So it can be good if your operator knows what they're doing, if you get paid back in 12 months. And there's some ifs in there, but in theory, yeah, it can be really good.
Yeah, to me, it just doesn't intrigue me at all. It just sounds like you're in a rat race that I don't ever want to be in. It's just like because you're
Right.
constantly having to loan out money, you're having to wait for these people to do projects or these flips. It's like,
Yeah.
they're flipping and then they're flipping again and flipping again and flipping again and flipping again. It's just like I don't know why. I guess some people like that chaos. I don't, but it's just not for someone like me. I'd rather work smarter, not
Yeah.
continue to do the same thing over and over again just to make more and more money.
Yeah. Yeah, for sure. No, and the passive income is really where it's at. Again, I'm starting to get a little bit older here. We're looking down the road. My youngest is 15. So I'm looking, 4 or 5 years down the road, when we're empty nested, then what? So this is where we're putting into place this fund so that we can build up our own portfolio and just have payments coming in. That's really all I want. Monthly income with little effort.
I mean, the effort is the X amount of years you worked.
Yeah, it's the upfront work for sure. But I've put in my hours, I've put in my months and years. I would like to benefit from that.
Yeah, and that's something, a lot of people don't understand. It's like, hey, you come out of school, you get a job, like you can't expect to like double your income in a year unless you're in like a sales job or a job that has that sort of potential.
Right.
However, eventually you're going to max out on that because the companies put in these systems and ceilings in place to ensure that, you can make a lot of money, but we're going to make sure you don't make so much where you're not profitable to
Yeah.
the company. And then you get stuck in a place, and a lot of people get stuck. They're like, well, I was making, you know, a dollar at this company. Now I'm making 70 cents at this company. I got to get back past a dollar. Like, how am
Yeah,
I going to do that versus just like building something and letting it grow over time? And it's hard for a lot. I'm sure you went through the same thing. Everyone does. It's like,
sure.
uh, what is it? Like what does Garfield say? If I just sit here long enough and wait, things will come to me.
I suppose in theory, sure. But yeah, no, I
Meaning
totally
like
get it.
don't force the issue. Like you can't force deals that happen. You can't force like a good deal to just show up. You
Yeah,
need to know where to look, but you can't like, you just can't make things happen and like continue like forcing. You have to let it happen, let it flow, and just eventually it just becomes easier and easier. And
for
it's just
sure.
like, how do you make it look so easy? It's like, well, I've been doing this for a long time.
Yeah,
I know how to do this, just like you
yeah,
know how to brush and floss your teeth.
yeah. And it's important not to try to force a deal. If it's not right, walk away. Like it's not worth it. And speaking from experience, where you get into something and oh, because the numbers look so good and it all looks so great. But did you do all the research? Did you figure out all the different things that could go wrong and then do go wrong? Um, so not putting your money into something that is so high risk that, yeah, you're lucky if you make a buck in the end.
Yeah, I mean that comes down to what a lot of people say in like the investment world is like your margin of safety. And
Yeah.
it was in the book. What's the book? Monish Prabhai wrote it, and he was talking about like the Patel family that like
Mhm.
owns the most amount of hotels in the United States, and they would buy the hotel, and they'd be like, "Well, my family can live here, so we don't really pay any rent." And then basically, if they only rent out X amount of rooms, they can pay the amount of money that they owe each month. So it's like a heads I win, and they're like, "Well, if I don't make the payment, then the bank's probably gonna want to work with me because they don't want to own this thing anyway."
Yeah. Yeah. No, that works. That works. But thinking it through and being smart about it for sure.
Yeah, because I mean, most people only think about like, oh, this deal's gonna go through. I'm gonna make this much money. Like it's
Yeah.
bulletproof. However, like Charlie Munger said, it's like when I think about a company I want to build, I reverse engineer. It's like, what would I do to destroy this company? So it's like,
Yeah.
not negative thinking, but like, hey, like if this deal were to go wrong, what could happen? So that way, like you thought about it, you
Yeah.
weighed the pros and cons, be like, well, I could make this, but I could lose this. Is it worth it?
Yeah. Yeah. And so with note investing, you're looking at, for me, the worst case scenario is I got to take back the property. So the property in the very beginning, that is part of the due diligence, making sure the value is what we think it is, as you know, as best as we can tell in today's condition, not as an after repair value or not as like some mythical maybe value, but like as is condition, what's it worth today? And then that's really the basis of it, making sure that if we ended up taking back this property, are we still going to be okay?
What's your process for figuring that out?
So I do a lot of internet research on it first. I live up in Canada, so everything I do is remote. Everything's in the US. So I'm doing internet research just to see what the house looks like. I look at surrounding properties to see what sales are going for in that neighborhood. Again, in today's time, not something that sold 3 years ago. Uh, as accurate as we can get what's happening today on the ground. Once I've done that, I'll actually have a local realtor go out and lay eyes on it. And it has happened where they went to go out to the property and it's no longer there. The city erased it, or it burned down, or something happened to it. And that has happened. So I always get a local realtor out there. First of all, just make sure it's there, to make sure it's in the condition we think it's in, and then to give us their opinion of what the value is versus what I found online. Because again, I can find whatever I want to find online, but the person who knows the market, who knows the area, who knows the street, I want them to tell me what it's worth versus, my virtual research. So
How do
that's a big part of it.
how do you compensate the realtor? I'm sure you pay them something, but like, do you pay them before, after, half now, half later? What have you found that's worked? Because anyone that's owning a business or looking to pay people, we've all paid someone on the upfront, and then the work just somehow never gets done, and that person disappears.
Yeah, yeah. I typically use different BPO services. So it's a company that's already set up where they have realtors that have, joined in to be somebody that can go out and provide a BPO. That's typically what I use, especially if it's first time in that area.
Hmm.
Once I've worked with them a little bit, and then they get paid after they give me the report. Um, Otherwise, after I've worked with them, most often they'll actually just go out and do it for free because they understand how I work, and if there's a good chance that I'm actually going to take back this property, say if in case of a non-performer, they're happy to do the work because they know they're going to get the listing sooner or later. But even in the performing stuff, if they want to get paid, typically I'll still just go through the BPO service, just for checks and balances to make sure that it's done properly and on time and all those kinds of things.
Yeah, you're basically paying for insurance that it's going to get done and you're not going to get
Right.
scammed.
Yeah.
That's something they don't teach you. They probably don't teach you that in business school. It's like
No.
it's smarter to just like pay through a service company so that way you have like a checks and balance versus especially for those sort of services, especially like marketing services. Because if you're just hiring an agency and they're like, "Hey, I want $10,000 up front," you're going to pay for your own ad spend.
Yeah.
Uh, there's lots of horror stories around those sort of things.
Right. Yeah. Yeah.
Now, I was working with someone and they introduced me to this website called like withrome.com.
Okay.
Have you seen that?
No, I don't know that one.
So there's probably some overlap, but basically like you go to withrome.com and you can go on and assume someone's mortgage at a lower rate.
Okay. Interesting.
So it's a way for people who want to purchase real estate who have the cash and they don't want to get a new mortgage, they can just assume someone's mortgage.
Yeah.
And I found that very interesting because when you talk to a mortgage person, they're going to want you to do a whole new mortgage because they probably don't make any money if you just assume someone's mortgage. It's just knowing how to do the paperwork.
Yeah. Yeah. So getting a little bit into different kinds of real estate investing, there's a strategy called, subject to. So they will go out and buy somebody else's mortgage, assume it, and then they go back and resell the property out to somebody else, and they'll move in there and be the new homeowner. that can happen, and there's ways to do that. And I'm not going to get into it because it's not my specialty. My specialty is buying the note. So I've been approached several times now where they call it a wrap note. So the person living in the home, now they have a new mortgage that covers that existing mortgage that's still there as well. In that case, if somebody comes to me and says, "Hey, do you want to buy this note?" The answer is yes, with a caveat. When I buy your wrap note, whatever my purchase price is, has to be enough to pay off the whoever is trying to sell me the note. They have to pay off that underlying mortgage. I don't want there to be two mortgages on there. I just see that getting extremely messy extremely fast. Let's say that new borrower quits paying for some reason. Um, Now I'm in a situation where that underlying mortgage is still there. I would have to come out of my own pocket. I don't necessarily want to do that in the first place, but then I've also got this assumed mortgage where I was never part of that relationship, and so it just gets really messy. So I don't want to deal with any underlying stuff. Whatever I'm buying, it has to be for myself. It's got to be first position. I want to be the one who's in first position. I get paid first, and I don't have to pay somebody else from whatever I'm getting paid.
Sounds simple. Have a strategy, stay in your lane, and
Yeah.
just focus on the boring work.
Yeah, exactly. Exactly. I'm actually doing a presentation next week. Uh, Presentation is called Why Boring is Better. And it's all about just keep it simple. If you want to get crazy, fine, but make sure you've got at least a portion of your money just doing the boring thing.
Boring works.
Yeah.
Well, sweet. Appreciate everyone. Check out Nathan's website. It is earnestinvesting.com. He's also doing a podcast. He has an expo coming up, so check him out and we'll see everyone next
Yeah.
time. Bye everyone.
Awesome.